Let's bring in Nick Hollis. He is the co-founder of DataTrek Research. The financials make me nervous, Nick, especially after the run-up we've had and with they never feel like they're that great of an earnings story. So I'd love to hear you unpack this.
Sure. I mean, the financials as a group include some very high-quality growth companies as well, like Visa and MasterCard. So it isn't just the banks.
True.
It's right now a much higher quality group than before Visa and MasterCard were added. So you have some growth and you have some value. As far as the bank side of the equation goes, I think the primary story is just a continued decent U.S. economy. Not super strong and certainly areas to worry about, but strong enough that we don't have to worry about big loan loss reserves in the next 4 quarters. And that's what really hurts bank earnings ultimately and makes investors question how sustainable they are. And on that count, I think we're in pretty good shape. And as you showed, the multiples are extremely low relative to the market. So for value investors, it's our top pick by far.
What are your other Trump trades?
The most important Trump trade, this is super important, is if you look back at Trump 1.0 from election day 2016 to the end of 2019, so pre-pandemic, U.S. stocks outperformed everything else around the world. There was not one major global index by country that outperformed the U.S. S&P was up 50%, and the rest of the world was up like 25%, and not one country outperformed. So the most important thing to understand is to be overweight U.S. stocks.
And that's even with a dollar that is up every time I check, it's marching higher.
Yes. The dollar rallied 1% over the period that we're talking about here from 2016 to 2019. It actually fell in the first year of the Trump administration in 2017 by 7%, kind of gave non-U.S. stocks a little bit of a lift. But overall, it was stronger, and a stronger dollar is certainly part of the Trump trade. But it shows capital is flowing into the U.S., and part of that capital is going into U.S. stocks.
Do you think they can achieve similar outcomes this time around when the multiple 6 turns higher than it was back then and at more or less all-time highs, and without the prospect of corporate tax relief?
Yes, both great points. I think we can expect multiples to hang around here or head a little bit higher. Multiples actually, as much as we'd like to think they're very precise numbers, they're very fungible, and they measure investor confidence. And as long as confidence is high and rising, multiples tend to rise. They are at very high levels right now, but it shows very high levels of confidence. And barring a recession, barring a real downturn or a shock, like an oil shock, they should hold. It's uncomfortable. 22 multiple is an uncomfortable number, but you have to stay invested because it can go higher before it goes lower. And if you lag, you're going to regret it.
A final question, because this all sounds so reasonable, Nick. Given all the energy and hype of the past week, I'm like, all right, what about small caps?
Small caps are, I think, a great trade through year end. They have really lagged. The Russell's still not back to the 21 highs, which is amazing considering how much higher the S&P is. They've lagged a long way. And right now, particularly on like a 3-year hold basis, they are very reasonable holds because over the last 3 years, they're flat, which is amazing. They're usually up 20-odd%. So we're looking at a longer term picture for the small caps that's pretty good. And given the enthusiasm about deregulation and everything else, small caps should work through year end quite nicely. We like them.
I will get more excited about them if rates will take a breather a little bit, because that was such a culprit the last few years as well.